And shares of Meg Energy and Cenovus Energy under pressure today. Meg has postponed a shareholder vote on the proposed takeover by Cenovus over fears of falling short on votes needed for the deal to go through. We're joined now by Eric Nuttall, partner at senior partner at senior portfolio manager at Ninepoint Partners. Easy for me to say today, Eric. Thanks very much for joining us. Let's talk a little bit about what is going on right now. What's the newest situation here between these two?
Yeah, you bet. Well, very clearly, Cenovus has come up short, deferring the vote by a week and a half. I'd say that was unexpected. Most people would have thought that given how much stock was being held by merger arbs, that they would have been able to get this across the finish line with their upwardsly revised bid. So there's really four potential outcomes here. One is over the next week and a half, Cenovus finds the remaining 3% of shares outstanding to vote in their favor. So that's number one. So the deal goes ahead. Two, they are unsuccessful, and yet they can then convert this share arrangement in favor of effectively a friendly hostile takeover bid, at which point they only need 50.1%. I would say that's the most likely outcome if they can't get the 2/3. Thirdly is they decide to walk, at which case we think the stock would fall to roughly $22 to $23 on forced liquidation, and no one else comes to the party. The fourth is Strathcona is still in the wings. We think that Adam Waterous would still love to own this company, love the assets. And so if option number three came to fruition and the stock did sell off, we would think it highly likely that he would entertain trying to convince shareholders on that weakness that his original bid was a good one. So four potential outcomes. We think the most likely is Cenovus will either get the remaining 3% of shares, or if failing that, they'll just convert it to a friendly takeover bid.
And what's giving you confidence in that?
Well, I think if you look at one, every vote to get from this point is probably incrementally harder, but it's a relatively small bogey. Two, typically the merger arbs will vote in favor, and I think if it becomes clear that Cenovus is not going to increase their bid, which we don't think, then those are the most likely. But honestly, I hope option number three, I hope the bid fails. I hope the stock does a faceplant. We sold our position in the 28s thinking there was a strong risk of both bids failing. Since that time, we've had Strathcona walk, and now Cenovus seemingly more challenged. We would love to buy back our position on the sell-off.
It's down a little bit right now, 29.02, but still some room to go. And what happens if we don't get the first and the stock does drop? How long are people going to tolerate that, or before somebody moves in, or I guess Strathcona would move in, but how long could it wallow?
I think everybody, this has been one of my favorite stock for many, many years. We've made generational wealth for our clients owning it through that time period. I would love the opportunity to buy it back. I'm really, really quite annoyed that Adam Waterous, and I have all the respect for the gentleman. He's made a ton of wealth for his clients, but I'm very annoyed that he put one of the best companies in Canada in play at a cyclical low, resulting in a price that massively undervalues this company relative to its long term. So I think eventually a strategic would come in, or investors such as myself who like the story, just didn't want to take on the deal risk, and were effectively forced to sell the stock.
And two potentials. What happens? Cenovus wins. Where does it go? What do you see them doing with it?
Yeah, so we own Cenovus. It's only one of four oil stocks that we own at the moment. We're a short-term cautious-ish on oil. We see, there's a lot of concern in the market on growing inventories on water. We don't think it's a clear-cut case that oil is going to sell off further from here. So we much prefer natural gas than oil. However, one of the oil names we own is Cenovus. We think they've righted a lot of their downstream issues. So if you own MEG and you tender, you're effectively getting about half of your stake in Cenovus shares. Cenovus trading at 24. It's trading at about a 2-turn discount to Suncor, about a 3-turn discount to CNQ, Canadian Natural Resources. We think that is unmerited, given they've subsequently turned the corner on the refining issues. They have some of the best quality oil sand assets in Canada. If they get MEG, they will have the best oil sand quality assets in Canada. And we think fair value at $60 oil is about $30 a share. We're a believer that in the second half of next year, you could see well above $70, at which point we would see fair value exceeding $35 per Cenovus share.
And if it goes the other way and Strathcona wins?
We're not favorable of Strathcona's share price. We think the stock has been strong on index buying. They've done a good job of doing countercyclical bids. However, we're not fond of the overall quality of their asset relative to a company like a MEG. We also don't like the liquidity profile, and the Waterous Energy Fund is ongoingly divesting its position to increase the float. Even in so doing, I think by January, they would still own roughly 67% of the company. So that's very thin, and it precludes their ability to meaningful share buyback. So at a time when sentiment remains challenged, even though fundamentals remain relatively strong, the real key ingredient for meaningful share price outperformance is the ability for a company to buy back their stock, and meaningfully so. Those companies that are doing it today, such as an Athabasca and Imperial, are performing very, very well. Those companies that have not been buying their stock are stuck in the funk of today with sentiment, and their share prices have underperformed. So we're really focusing on companies that have the ability to meaningfully buy back their stock from the free cash flow that they're generating.
Okay, and just one last bigger picture question. You mentioned oil and natural gas. You're leaning towards natural gas right now?
We are. We think the marginal cost of supply is $4. It sounds idiotic, but the trade always works well when Mother Nature shows up with winter. And here we are, the first forecast for cold weather in North America, and you had natural gas squeeze up yesterday. The strip gas price for 2026 and 2027 is just a snick above $4 per MCF. At that price, we own companies trading at 12, 13, 14% free cash flow yields, primarily in the United States, with market caps, measured in the several billions, so they're more relevant to larger shareholders. And given that they have 20, 30, 40 years of stay flat inventory, have the ability to buy back their stock. So our preference today is natural gas over oil. Let's call it a shorter term tactical call. We know that LNG demand in the United States is almost going to double over the next 5 years, from roughly 17 to 30 BCF a day. Data center demand is real. We expect 5 to 10 BCF a day of incremental demand over the next 5 years. Basins are becoming more mature. The Marcellus is pipeline constrained, and therefore the incremental supply to satisfy the increase in power must come from basins like the Haynesville, where they have simply a higher cost of supply. And so at $4, that is strip price, names remain meaningfully undervalued. If we have a normal or even a colder than average winter, we see the prospect for $5 or higher natural gas pricing, at which case we think the stocks that we hold could potentially double.
Okay. Eric, thank you, as always, for joining us.
My pleasure.
Eric Nuttall is a partner and senior portfolio manager at Ninepoint Partners.